How does the IRS typically detect situations, though, where financial information may not match what a taxpayer's originally reported?
Well, what they do is when they're looking at the expenses, if it's a they're self-employed and they got a big number for a certain expense, that's probably going to be a red flag to the IRS, might trigger an audit. But the other thing is, if you put something down on that financial statement, you better have documentation, particularly if you exceed the national standards. The national standards, it's a list. For example, housing and utilities, the IRS will tell you how much you can take for housing and utilities, and it varies depending upon the county in which you live and the number of people in the household. Now, it's arbitrarily low. So, most of the time, we have to submit documentation so that the IRS will give the taxpayer their actual expenses as opposed to the national standard. So a lot of times you have to submit proof to the IRS to back up what you're putting on that paper or what you're telling the IRS your expenses actually are.